Hi, my name is Colin Bernd, Associate Financial Advisor with Advent Partners, here to provide this week's market commentary. When I was in high school, I ran track and field, primarily distance events. And one of the first lessons you learn running track is to not celebrate too early. At nearly every meet, you would see someone in the lead coming down the home stretch, starting to celebrate, only to be passed at the last second. It goes along with the adage, don't count your eggs before they hatch. In track, it is easy. There is a defined finish line. But oftentimes in life, it is less concrete, more arbitrary in nature. One has to decide, when is it the right time to declare victory? When is it appropriate to start celebrating? And that is how I feel the Fed is right now. They are feeling good. They are coming down the home stretch. Inflation is cooling. They feel like they have it under control. And they are starting to wonder, when is it okay to declare victory? After many months of a high interest rate environment, the Federal Reserve is expected to begin rate cuts at their September meeting. While the size of the cut is still uncertain, economists forecast a 25 basis point cut. After this long battle with inflation and price stability, the Fed might start to switch gears to focus on the other half of their dual mandate, which is maximum employment. Recent data has shown the unemployment rate tick up over the last several months and the labor market soften, as I will cover in a bit. This was confirmed last Friday as one Fed governor stated that they have shifted more toward employment concerns and that he was open to the idea of a larger rate cut to help stimulate the labor market. Rate cuts are expected to continue well into next year as inflation continues to slow. Labor market concerns led the headlines in the stock market last week. The S&P 500 posted its worst week since March 2023, as a disappointing August jobs report renewed concerns about a cooling economy. Despite the drop, which saw the S&P 500 fall 4.22% last week, the index is still up about 14.5% year to date. Non-farm payrolls rose by 142,000 in August, bringing the 3-month average down to its lowest level since mid-2020. Volatility as a whole has been lower than expected this year, so it is not surprising to see some more swings after the strong performance we have seen so far this year. The next major headlines to keep an eye out for are the impact of the debate and inflation data, and these should drive the markets over the next several weeks. Thank you. Have a great week.